In this video, you're going to be learning one breakout setup, two pullback setups for all time frames. These are my favorite entries. They're called trigger bars, gap down reversal bars, and shakeout demand tails. We're going to split this video into four main sections. Number one is going to be education. Number two is going to be a quiz, see if you actually learned something from this video. Number three is how do you screen quickly and efficiently for the type of setups that I'm going to be showing you in this presentation. And then fourth and finally, how do you put it all together and actually execute a trade? That's what I'm going to show you right at the end. MarketSmith are today's video sponsor. There is a discounted trial available in the comments below. So here we go, guys. I'm actually going to show you the questions that you're going to get later on. There's going to be 6 of them, and I'm not expecting you to know the answers right now. In fact, I don't want you to know the answers right now, because hopefully at the end of this video you'll go, there's a trigger bar, there's a shakeout demand tail, there's a gap down reverse bar after 21-day EMA, and you'll actually learn something from the video. It made me very happy. So these are the questions that you're going to get asked a little bit later on. Can you find certain type of candlesticks around certain moving averages? And hopefully it'll all make sense to you as well. So these are the questions that you're going to be getting. You can pause the video and see them if you want now. Try and answer them now, but you're certainly going to be having a go at the end of the video. So phase energy, numerous bases here. I'm going to get you to look for different candlestick, gap down reverse bar, shakeout demand tails around certain moving averages, and hopefully by the end of the video you're really going to get a good understanding of how do leading stocks move. And there's a key emphasis on that word, leading stocks, okay, not lagging stocks, leading stocks. So there's going to be a heavy emphasis on the identification part of leading stocks, looking for the right type of stocks, and I'm going to keep going on and on and on about that during this presentation, because it's really, really important. So let me just start here, okay? This is an absolute textbook setup. This here is 10 out of 10, and you may be looking at it and going, why is it 10 out of 10? I have no idea why it's 10 out of 10. All I can see is some pretty colourful lines there. There's some red bars, there's some green bars, there's some volume there. What on earth is this line down here? What are these blue dots on the line? Why have you got blue dots on the line? Why have you put a blue line there and a red line there? Why have you put it at 66.36? Why have you put it at 65.39? Why is it 1.46? What on earth is going? Why are you pointing to the low volume? Why is this a really tight bar relative to it? What does all that mean? What does all that mean? So this is the point where we're going to get to. At the end of this video, I'm really hoping you look at this chart and you go, that's a ridiculously good setup. Like, that is textbook. That's ridiculously good. That's where we're going to try and get to at the end of this video. So why don't we just start and see if we can get there. I jumped forward too many slides. Here we go. Okay, so this is what you need to know first and foremost, okay? We're going to strip it back a little bit, and I know some of you experienced traders will be like, oh, it's a candlestick, does it really matters, okay? For these type of entries, okay, you're looking for me, it's a deliberate practice. It's a nature of, okay, what am I doing? Why am I trying to do it? Where am I trying to do it? What type of stocks am I trying to do it on? Okay, it all feeds into each other. Remember, identify, control, mitigate, and optimize. So we've got to understand what are optimal candlesticks to be looking for entries, and then we tie it in with right stock, right location as well. So for me, these are shakeout demand tails, okay, really important. So they're hammers, they are doji dragonflies and takuri, I think that's how you pronounce it. My Japanese isn't very good, okay, takuri lines as well. So this is data from Thomas Boswellski's book, The Encyclopedia of Candlestick Charts. I'm even going to put a laser pointer on. There we go. So these are shakeout demand tails. You can pause the video, you can see the reversal rates, okay, 60%, 50%, 66%. So these are the type of candlesticks I'm looking for shakeout demand tails that you're going to see, but it's right stock, right location as well, from the base structure, so what's happening in terms of the price, but also bringing some key moving averages. So this is what we're going to be looking at for shakeout demand tails, and then we have what I call a gap down reversal bar, where price gaps down and reverses like the name implies, right? So these are the type of candlestick patterns that make up gap down reversal bar. So you have a piercing pattern, you have a belt hold bullish, the reversal rate of that is 71%. You have meeting lines bullish, 56% reversal rate, of thrusting 57% reversal rate, of bullish engulfing candlestick 63% reversal rate as well. You can pause the video if you want a little bit more data and you want to spend some time reading this. And then there's also trigger bars, okay? Now Thomas Boswellski wasn't testing the kind of exact trigger bar setups that I'm looking for, so I'm going to show you a bit of work from Toby Corbell, who's a billionaire hedge fund manager, and it'll make a little bit more sense. But when I'm talking about trigger bars, okay, a little bit later on, and that's what we're going to start with, I'm going to teach you trigger bars, shakeout demand tails, then gap down reversal bars. So trigger bars are often tight, low volume inside bars sitting around one or more key moving averages. And don't worry, we're going to get to what are the one or more key moving averages, but this is what I'm looking for, okay? Sometimes it's back-to-back inside bars, sometimes you see a shakeout demand tail of say the 21-day EMA, and then you get this nice little what I call a trigger bar inside bar, preferably low volume as well. It's really nice to see. But this is really important. I can't stress this enough, okay? This slide here, you may just be turning, going, there's a load. It's really important, like really important. It's so important. Toby Corbell, who's the billionaire hedge fund manager, you can go Google him if you want. He wrote a book back in the 1990s publishing this and publishing the studies. And then he went, I don't really want anyone to know about this. So he decided to start buying up all the books he possibly could. So to try and get a copy of his book, it's ridiculously rare. They go for around about 1,600 quid on Amazon. But don't worry, this free YouTube video, I'm going to teach you basically the highlights of the book. So Toby Grubel wanted to know, is it better to be looking for trades after there has been what he calls range expansion or range contraction? Okay, so we wanted to know, okay, if there's like a really bullish candlestick or a really bearish candlestick, so it can be expansion to the upside, it can be expansion to the downside as well. He wanted to know, well, is it better to be entering after you see that wide range expansion bar? So for the purpose of this, we're just going to say it's a wide range expansion bar to the upside. Is it better to be entering after you see that bar, or is it better to be entering after you see contraction? So what he was basically testing is the principle of expansion and contraction and expansion. So what that basically means is expansion follows contraction and contraction is followed by expansion. Okay, the two just work in tandem to each other. One follows the other and vice versa. Okay, it's like a constant dance that you'll see in the market. So he tested various different entry methods. So he called it a widespread 4, a widespread 7, a narrow range 4, and a narrow range 7. Now I'm just going to skip to the highlights. If you want to read about the definitions, they are right there for you. So these are the key findings. As I said, I'm going to give you the highlights of the £1,600 book on Amazon. So a cumulative total of gross profits for contraction patterns versus expansion patterns on the trade in the direction of the move off the open showed $710,000 profit for contractions on 7,313 trades and $102,000 profit for expansions on 7,500 trades. Profits were 7 times larger for opening range breakout trades after contractions than expansions. I'll read that final bit again. Profits were 7 times larger for contractions than expansions. Okay, so contractions are really, really good to be looking for. So this is the principle of a trigger bar, okay, and you're going to see some setups. So some of you then maybe when you look down here and you look at a 2-bar narrow range and a 3-bar narrow range, some of these patterns now may feel a little bit more familiar with you if you're used to trading, say, flags, Darvis boxes, pennants, wedges, VCPs, cup and handles, all of that stuff, right? So these are really, really important type of setups to be looking for, okay? And the psychological implications of a pattern of this type is interesting. In general, as the pattern is forming, speculators are absent. In fact, they tend to ignore a market that has contracted to such an extent. This is the point where the market is most ready to move. This is the point where the market is most ready to move. Why? Because expansion follows contraction. This is contraction and present an explosive opportunity. So you want to be looking for where there can be these explosive opportunities. Okay, it's really key. It is ironic that so little interest is given to the move out of this pattern. It is well-trained traders that recognize these opportunities and provide for the force that takes the market into trend. So here we go. Let me now start showing you a couple of these. So these are what I call trigger bars, okay? Now, this is going to be a common theme throughout. Before we even start looking at the chart, well, we are going to look at the chart. We're just going to look right at the bottom of the chart. This is super key. It's so important. Focus on leaders. Focus. How do you know it's a leader? You might be like, what do you mean a leader? How do I know it's a leader? This down here, this line, this is not an RSI. This is a relative strength line. I get a lot of comments. Oh, what's the RSI? It's not an RSI. They are very, very, very different things. This is the relative strength line currently set versus the S&P 500 because these are New York Stock Exchange or NASDAQ listed stocks primarily. So this line here is the stock in comparison to the S&P 500. It is a relative strength line. And then what are these pretty blue dots that you see? These are 52-week highs on the relative strength line. So what is that telling you? The stock is significantly outperforming its index, being the S&P 500 for here. Now, if you're trading different stocks in a different market, it probably doesn't make much sense to use the S&P 500, right? So you can go into the settings. It's a free tool on TradingView. Search my name in the indicators. You'll find it and change it to the most applicable index for the stocks that you are looking to trade, okay? But this is going to be a common theme throughout, that you'll see a relative strength line in a nice, powerful uptrend like this, and you'll see 52-week highs on it as well. It's really, really key to be dialed in to the leaders. Why? Because relative strength, okay, this line here, this relative strength and these blue dots, it is not your opinion. It is not my opinion. It's the opinion of the market, and the market won't miss the best opportunities. Okay, if you have that as a belief system, for me, it serves me really well. The market won't miss the best opportunities. I just trust the market. I don't know anything. Okay, I don't know what the best opportunity is. I'm just going to leave that to the market to decide. The market will tell me what the best opportunities are because they'll have the highest relative strength. I just want to focus there. I want to focus on where are the smart money, where are the really good institutions, where are they playing? That's where I want to be. Okay, so then the concept of trigger bars, right? So what you are basically looking for is you are looking for tight, low volume, most of the time they are inside bars as well, that occur on one or more key moving averages. So that's going to be either the black line, which is the 10-day EMA, the blue line, which is the 21-day EMA, and potentially the 50-day moving average as well. You can oftentimes get a clustering of one or more key moving averages where they get really tight. You'll see a couple of setups like that. And then you'll see this black line across the volume. This is the 30-bar average. It doesn't matter if you want to use 27.5 days or 33.3, it doesn't matter. 30-day works absolutely fine. You're just trying to look at things on a relative basis and apply some common sense. So then what I'm looking for is stocks in powerful uptrends that then start basing and building cup and handles, flags, Davis boxes, wedges, pennants, whatever you want to call them. We've done that a lot in the blueprint video and loads of other videos on the channel as well. So you're looking for stocks in powerful uptrends that then start basing, finding supportive action around one or more key moving averages, and then put in these trigger bars or shakeout demand tails or gap down reversal bars as you're going to be learning. But the relative strength point is really, really important, and ideally you want to see huge relative volume coming through as the stock is trending up. So look for these big volume spikes, really, really, really key. And then I'll explain maybe on the next chart how I think about entering it as well. So this here will be split adjusted 101 times, okay? So IGT, this is back in 1988. I wasn't trading in 1988, but what I've tried to do is show you historical examples and then more present day examples, and we're working through in chronological order like that. Okay, so this one here, you get a little bit of a bigger base, right? So the stock is in the context of an uptrend. Remember what I said about looking for the relative strength line to be in a powerful uptrend and 52-week highs. Now, I'm going to make a really important point here. It may go over some of your heads, but this is going to be really important, okay? Do you see here? The stock is basing, right? It's basically building like a Davis box. A Davis box is pretty much a rectangle, okay? So it's building this Davis box here. It's not going anywhere. It's just horizontal, okay? It's not really going up. It's not really going down. It's just flat generally, okay? A Davis box, a rectangle. We all know what a rectangle is, right? But you can see here, the stock is hitting these blue dots, these 52-week highs, and it's still in the base. It's not like here where it's trending up and you see the 52-week highs. It's in the base and it's hitting 52-week highs, but the stock's not going anywhere. It's just going sideways. What does this mean? It's telling you the stock is holding up and the market is trending down. The S&P 500 during this time is most likely making lower lows and lower highs, the definition of another downtrend, but the weakness of the index cannot drag the stock down. The stock's just going, no, I'm going to hold up here. Institutions, for whatever reason, are supporting the stock. Now, I'm going to make another point here as well. Do you see this magical purple line here? This is called the 50-day moving average. Now, go back and study some of the market's biggest winners. Study random stocks as well, but I'd really focus on the leading stocks of their time, the ones that are hitting 52-week highs, okay? You will see quite commonly, and I'm going to show you a couple of shakeout demand tails perfectly off that moving average a little bit later on. You will see that can be a region, and it happens on such a consistent basis. It's not just fluke. Okay, you can go back and look at decades and decades and decades ago. You'll see the same thing, right? You will see the stock find supportive action around this purple line. Not all the time, but sometimes. Oh, that's interesting. And then does it put in one of those three candlesticks? Does it put in a trigger bar? Does it put in a shakeout demand tail? Does it put in a gap down reverse bar off of that moving average? Remember, the black, the blue, and the purple line is really where you're looking for these setups when you see an optimal base forming as well. Cup and handle, flag, Davis box, wedge, all of that good stuff, okay? And then here, remember what Toby Krabel taught you. Expansion will follow contraction. Look at the tightness in price. Okay, look at the tightness in price. Look how the volume dries up. Look at the 52-week highs in the base. Now, we'll briefly just talk about the optimizing profit. So for me, I like riding. I will free roll the trade, which I'm going to teach you a little bit later on at the end of this video, but I like riding the black line and the blue line with parts of my position. So for me, I'm an intermediate term trend follower. Okay, I'm a swing trader, primarily using the daily chart. I like using the monthly, the weekly, the daily, and the 1 hour. They're my go-to time frames. I would say I probably spend 90% of my time on the daily chart, but I use those other time frames as well. Then what I'm looking to do is free roll the trade by selling part of the position. I'll teach you all that a little bit later on at the end of the video. And then I'm looking to ride the black line, and then I sell part of the position on close below the black line, and then part of a position on close below the blue line. Don't overthink it. And then if it starts getting extended from the 10-day EMA, I may just choke off part of the position. Absolutely fine. It's nothing crazy. Okay, AN, okay? Remember, this here, okay? What follows contraction? Expansion. Where do you see the contraction? On the black line. Look how the volume dries up. Now, this is quite key here as well. Huge volume, can signal a lot of interest. So you see here with AN, okay, something for some reason just sparks this stock higher. Now, if it's a biotech, it may be an FDA approval for a drug. Maybe it's an earnings report that comes out and the company just blows the estimates out of the water and they raise their full year guidance by double or triple or something like that. And the market's like, well, we've got to react to this kind of thing. And then you see this optimal base forming, okay? So ideally you want to see flags, pennants, wedges, Davis boxes, VCPs, whatever you want to call it. But ideally the stock is then basing and building higher lows and showing respect for one or more key moving averages. For me, I think the most important ones are the 10-day and the 21-day EMA, but the 50-day is also going to be very important as well. But then look at the tightness coming through, okay? Tightness and price, it's really key. It helps create more of an asymmetric reversible trade. Now up here, clearly the stock is extended, okay? The stock's doubled in around about 2 weeks or so. So remember what I was saying about if it gets extended from the 10-day, I'll choke some off. So what do? I just move my stop loss on all or part of the position to lower the bar, lower the bar, lower the bar, lower the bar. Okay, if I think it's extended from the 10-day EMA and I want to choke some of the trade off. I'll teach that later on. Okay, EMA. So again, look at the move up here, look at the volume, look at the 52-week highs, and then you start to see the contraction. So what we're really trying to train your pattern recognition skills right now to is contraction, areas of contraction on a chart where you're going, wow, there is a clear area of contraction there. The volume has dried up as well. So what does this mean? When you link it back to a supply and demand perspective, what does this contraction mean? What does the tightness and price mean when there is sweet FA in terms of the volume as well? And you can see that on a relative basis versus this black line, the 30 bar. What does it mean? What does it mean from a supply and demand perspective? It means there's hardly any supply. There's hardly any selling. You are visually seeing it in the tightness and price and the low volume. If you imagine, right, the market is like a live auction place, okay? So if you think about it over here, okay, when there's a lot of volume coming through, there's a lot of bidding, okay? If there's an item at the front of the auction, okay, people are doing this, right? People are bidding, people are bidding, people are bidding, right? Imagine I'm an F1 fan, right? So imagine that Lewis Hamilton's car from 2020 or something like that, or 2023. Okay, the season that's just there. Imagine that Mercedes go, okay, we are going to sell that. We're going to sell that car. Do you think there would be a lot of people bidding for the car? Yeah. Imagine an auction place, everyone sat there and they bring up, right, we're now gonna auction off Lewis Hamilton's 2000, that's my stutter, 2023 F1 car. What do you think people are going to do? And we're going to start the bidding at $100. I'll bid. I'll bid, I'll bid, I'll bid. That's the volume, that's the bidding, that's the activity. You want to see a lot of activity. Certainly if the price is then appreciating, it's telling you people really want that. So if you link this stock chart here, maybe this analogy is working for you, maybe you've tuned off and clicked off, but if you link the stock price back to, this is Lewis Hamilton's F1 car. I want this, I want this. That's what institutions are doing. When you see the high volume and you see the positive price appreciation, like you saw on AutoNation here, institutions like, I want this, I want in, I want in, I want in. Okay, and then what happens over here is the bidding kind of dries up, right? It kind of dries up. Okay, it gets to a little bit of kind of a stalemate. People aren't that interested in it right now. Okay, and then suddenly someone else comes in and goes, no, I really, really want this again. So they push it right up like this. But just to link this back, maybe I'm going off on a tangent here a little bit. Okay, but if you imagine this, okay, if you imagine this here, okay, you have tight inside bar, tight, it's not quite an inside bar, the second one's pretty much an inside bar, and the volume's really low. So when you see this contraction in price and the low volume, there's no bidding. Okay, so imagine if this is now Nicholas Latifi's car from 2019 or something. Are a lot of people going to be bidding to it in relation to Max Verstappen's car or Lewis Hamilton's car? No. So you can just see this is, there's hardly any bidding going on here. And this is, as Tony Crabell said, this is the area where an explosive move can happen from. I don't think that analogy really made sense at the end with Nicholas Latifi and bringing it back, but hopefully for some of you maybe it worked, maybe it didn't. Okay, so what we have here, we have SLS. So what are we looking for? We're looking for a stock in a powerful uptrend. Okay, nice angle of attack like this. Okay, it's really good. We can see the 52-week highs, we can see some of the volume coming through, and then look for supportive action around certain moving averages. Black line, blue line, purple line. Okay, so here you see, you're going to learn about this. This is a gap down reverse bar off the 21-day EMA. The prior closes here, it gaps down, opens near the low, pushes up, pulls back down, puts in a higher low, and then you get this, it's another light trigger bar, right? It's a tight low volume bar sitting on the 21, and then over here you get this really tight low volume inside bar sitting on the 10-day EMA. Okay, expansion follows contraction. Really, really important concept. Doesn't just happen on US stocks. Here's a UK stock, okay, Pantheon Resources. So you can see the move up here. Okay, look at the volume coming through. I appreciate you can only see this part of the chart, but trust me on this one, this is big relative volume. You can see it versus the 30-bar average. Look at this is interest. This is Lewis Hamilton's F1. I want to bid, I want to bid, I want to bid, I want in, I want in. I want a chance of winning it. Okay, this is that. This is the marketplace telling you, wow, we really like this. This is institutions telling you, wow, we really like this. And then you're looking for, now this may sound a little bit kind of woo-woo, but hopefully by the end of this and you see so many examples, you're going to go, okay, it's kind of making sense. Leading stocks, they act differently. How do you know it's a leader? Remember these blue dots, okay? 52-week highs, really important. Leading stocks act differently, okay? You are expecting certain market participants, the better market participants in the market, to be involved. Now, this is why you can see that stocks have repeatable character traits, repeatable behavior, because for me, it's entirely logical. If you have the same market participants playing in these stocks, they likely have repeatable behavior, how they operate in the market. So you tend to see that on the charts. You tend to see, okay, leading stock finds support around the 21 or the 50. Okay, first retest of the 50, it bounces. Okay, it's trending, it's building bases into the 10-day. That's what I would expect. Okay, look at then the volume that comes through here, 52-week highs, and then it builds its base into the 10-day. Maybe there's not really a great entry in this one here, as good as like this one in here. There's a really nice trigger bar in here. But you're kind of expecting, okay, if this is going to be a leading stock, I'm expecting it to move in a certain manner. I'm expecting to see the footprints of the type of operators that I would like to see in the stock, that they're there, they're up to their usual games. They're putting in shakeout demand tails, they're putting in gap down reversal bars, they're supporting the stock where I'd like to see it. The stock's getting nice and tight before it comes out of a base. Now here, First Majestic, you actually get a gap down reversal bar onto the 21-day EMA with a little shakeout demand tail. Then here you get a shakeout demand tail, and then here you get a tight inside low volume trigger bar. Okay, so here, gap down, reverse bar, shakeout demand tail, tight low volume, inside bar, and the stock is building this flag type pattern. And where's it finding support? 21-day. So this is really important to notice, okay? The nice trend pre-base, and then as the stock starts basing, look for it to get supported on certain moving averages, around those moving averages, 10-day, 21-day, really important. Look for the volume to drop, look for the 52-week highs. Now for me, I'll just talk about how I kind of set these trades up. So I use buy stop limit orders with a stop loss attached. So what I do is the buy stop is the trigger price. I then attach a limit, which is usually 0.5 to 1% above the high of the entry candlestick. So the trigger bar, the shakeout demand tail, or the gap down reverse bar. Then I attach a stop loss, usually a penny below or a cent below the low of that bar. And then I like to see if the risk makes sense. We're going to talk about risk later at the end of this video when I take you through a recent example. This is CGC. So oftentimes the market can be thematic. So you may remember at the start of this video, I showed you ACB, which is a cannabis stock. Canopy Growth is also a cannabis stock. So the market can often be thematic in nature, that you say, wow, hold on a minute, there's a load of cannabis stocks setting up, or there's a load of oil and gas stocks setting up, or there's a load of solar stocks, or there's a load of semiconductor stocks here. The market can often be thematic in nature. So it's important to try and identify the leaders, but then also go, wow, okay, and all the brother sister stocks, maybe not all, but a lot of the brother sister stocks within this group, within this theme, are also acting well and basing. That's a very constructive sign. So again, here it starts building higher lows, 10-21 clustering. You get the volume dry up, the 52-week highs pre-base. It's really important. Gap down, reverse bar, check out the Montel there. Nice. Okay, EXPR. This is over here. This is an extreme example of a trigger bar. So you have a stock here. Nice rally here. Look at the volume coming through, okay? Starts hitting 52-week highs in the base. One of the strongest signs of strength the stock can possibly give you is this. 52-week highs in the base. It's telling you the market's going down, the stock ain't going down. It's trying to hold on in there. And then look at the tightness and price that comes through. And then it's perfectly sat on the 10-day EMA. So you then may look at here and go like, well, is this not a trigger bar? Like, look how tight this bar is. It's an inside bar. Yeah, but it's extended from the 10-day EMA. Okay, it's got to be at a minimum. I like to have my initial stop loss where the risk still makes sense, and I'll explain that later on. My initial stop loss underneath the black line, underneath the 10-day EMA. Okay, I'm not chasing trigger bars up here. I'm not chasing. You see this bar here? You may be like, wow, well, it's pretty much just gone back to back inside bars. There's a shakeout demand tail, then there's quasi inside bar, then there's a bar coming through here that looks really good. Why is that not extended from the 10-day? See the distance to the 10-day EMA. I like it at a minimum to be sat on the 10-day in there, or where I can get my initial stop loss underneath the 10-day EMA. That just stops me chasing extended stocks. Let's do a couple more. AMD, so see the tightness, tight inside bar, low relative volume. Look at the strength of the rally pre-base. Look at the 52-week highs, pulls in. You're going to learn about this bar, gap down, reversal bar underneath the 21. Prior closes here, gaps down, opens here, pushes up. Institutions up to their usual games here. Then look at the tightness. So look what is following the contraction, expansion. It's really important. It's just a timeless principle of the market, and these tight trigger bars can help you get really asymmetric risk versus reward trading opportunities. 1.5% initial stop, not bad. Novak, so this is thematic in nature. Okay, this is a biotech stock, COVID vaccine related play as well. Okay, look at the volume. Look at the volume here. Look at the volume here. And then it builds, okay, this wedge type pattern, whatever you want to call it, this wedge type pattern. And where does the stock find support? 21 day, 21 day, 21 day, tight, low volume, inside bar. And then a lot of trading, don't mess these up. When the stock wants to trend from $45 up to basically $160, $150 before it closes below the 10-day EMA, don't mess it up. Don't mess it up. Be there, ride it. Nail the home run trades. So key. PRTS as perfect a high type flag as you will possibly see. Pretty much. Okay. Look at the strength pre-base. Now this is an important concept as well. Okay. There's a lot of information coming at you, right? You can see the 52-week highs. You can see the stock is trending up. But it's not just, okay, the stock is trending up. How did it trend up? What did it do? So if you think about this from a trade management standpoint, if you're thinking about, okay, I'm going to use the 10-day as a trailing stop, or the 21-day as a trailing stop, or the 50 as a trailing stop, whatever you want to do, right? What I like to see is the stock not chop around all over the place during the uptrend, where it's just up, down, up, down, up, down, up, down, up, down, up, like this, okay? Why? Because for me, the best indication of how a stock's going to move in the future, how did it move in the past? So if I'm looking to then use, say, the 10-day or the 21-day as a trailing stop, okay, what I would like to see is pre-base, the stock doesn't chop around all over and close below those moving averages and back above, close below, back, and like this, okay? It's like a yo-yo all over the place. Why? Because from a trade management standpoint, when I get into the fourth part of the trade, I've identified it, controlled it, mitigated it, then I'm looking to optimize the profits. I'm probably going to get stopped out really soon, because the nature and the character of the stock is it just chops around all over the place. Okay, so it's the character understanding the stock, really key. This one here, Cabot. So what do you see here? You see a shed ton of volume coming through. Remember, Lewis Hamilton's F1 car. People are bidding. People love this. Now, there's another point here. I haven't put it on the chart. There was a load of insider buying. CEO, CFO, directors buying here. Multiple directors. I think the president was buying in here. Not the president of the US. President of company here, Cabot. Okay. So you can go and have a look at that. So when you get a shed ton of volume coming through, and suddenly the stock just like sparks to life like this, and there's a shed ton of insider buying, people remember that auction pace. Bidding. We want it. Okay. So then you see here, okay, builds this kind of like flag wedge type pattern into the 10-day, tight low volume inside bar here, bounces, pulls back down, 10-day EMA, look how the volume dries up, tight low volume inside bar, and then don't mess these ones up, okay? Don't mess these ones up. When the stock wants to run from $2, $10 before it closes below, it's 21, don't mess it up. Home run trades, so important. This is a video from this series up. Okay, so I bought it coming through the high of this bar here, but 21-day EMA. So here you get this low volume bar. It's not an inside bar, but this low volume bar. Look how the volume dries up. 52-week highs in the base, 52-week highs pre-base as well. Really, really nice. And then try and nail those trends. Okay, nail those trends. And video goes from 278 to like $450 before it closes below its 21-day EMA. Don't mess them up. And then in here, see how tight it gets in here as well? Little trigger bar coming through in there. These are really, really good bars to be dialing into. Now, Oracle, I can make another point on the relative strength line that you've heard enough about, no doubt. But relative strength lines, and if you get a shakeout demand tail, a gap down reverse bar, or in this instance here, a trigger bar, plus you get a 52-week high on the trigger bar, wow. Amazing, okay? Because this is telling you, look how the stock is basing, okay? Nice rally, pre-base. In the base, starts finding support on 21. Tight, low volume, nearly an inside bar there. Look how the volume dries up, 52-week high, 52-week highs pre-base. What is this telling you? The stock is basing, it's hit 52-week highs pre-base, the RS line is holding up, and then on the trigger bar, it hits a 52-week high. The market's going down, but the market can't drag the stock down. Institutions somewhere for some reason, and you can't go take out a clipboard and a questionnaire and ask, hey, why are you supporting? You can't go ask all the market participants, hey, why are you supporting the stock? Are you not selling? Are you holding? You can't do that. But visually, you can see their actions on the charts. That's the beauty of it. Okay, this is just supply and demand. When you learn to interpret a chart, it's just supply and demand. So when the market is going down and the stock's not, and the stock is basing, and the stock hits a 52-week high in the base, or even better on the entry bar as well, the market participants in the stock are telling you, we're supporting it. You don't need to know why, you just need to know they are. And then does it create a favorable trade? Really key. So then here's some other ones, right? I'll be quicker on these ones, okay? Just show you, you will see just trigger bars, gap down, reverse bar, shakeout, demand tail. You'll see them across all financial instruments. Go and have a look at Bitcoin. Go and have a look at Ethereum. Go and have a look at a load of cryptocurrencies when they were leading, when they were hitting, say, 52-week highs versus the S&P. Okay, Bitcoin here. Look at the contraction. Look at the expansion. This is what I want you to dial it into. Okay, look at the contraction. Look at the expansion. MX USDT. Look at the contraction. Look at the expansion. Where is it finding support? Look at the rally pre-base, and then 21, tightness and price. It's really, really, really good to see. Dogecoin, before it made a huge move and Elon was tweeting about it. See how it's in an uptrend here? bounce off the 21, tight, 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 rip through. Expansion follows contraction. Really important principle. So let's now go on to a shakeout demand tail. So the purpose of the shakeout demand tail, as the name implies, shake out the weak hands, okay? So these are going to be those hammers, those dragonflies, those teriyaki, something like that. My Japanese is terrible. I also have dyslexia, so pronouncing words and a stutter as well, you probably noticed. So pronouncing some words really, really difficult for me. But anyway, shakeout demand tails, right? So here you have shakeout demand tail. Would it be even better if it had a green real body, so it was a green close and goes out on the high? Yeah, it would be even better. But the purpose of shakeout demand tails, they're quite constructive to see in bases if they happen in the right location. So what is the location? We're looking for strong stock. Look at the volume. Look at the volume. Look at the trend. Now there's no 52-week highs on this one. Okay, so it's not as strong. We like 52-week highs. 52-week highs are optimal. That's the best thing to be looking for. But here we can see shakeout demand tail, and look how it basically undercuts the vast majority of base lows. If you look at this price action for the last 3 weeks beforehand, it just undercuts all of that. So you think about traders, think about people trying to get involved in McDonald's here. Now, I wasn't trading 1975, obviously, but it's the same thing from a supply and demand perspective. Large operators, they pass on their knowledge, they pass on their techniques, their tactics, their strategy from generation to generation. It's the same thing. Go back and look at this one I'm doing this slide, right? I'm showing you charts from 50 years ago just to illustrate it's the same thing. As is the principles of supply and demand, right? If you think about the traders trying to get involved here, where are they going to place their stop losses? I don't know, underneath this low, underneath this low, underneath this low. So here you get a shakeout demand tail, so it just goes and triggers all of those stop losses. And then here's a key on these shakeout demand tails and gap down reverse bars. When they undercut base lows or they undercut a key moving average, take a look at the volume. If the volume is less than the 30-bar average, what's it telling you about how much supply, how much selling's there? There's not much. If there was, you'd see it in the volume coming up, right? Because remember, this bar does not look like this bar mid-session. It looks terrible. It looks like this bar here or this bar here, okay? It's a wide red bar, it's on the lows. It looks terrible. We can't, I'm out of this. Change of trend, close below the 20, I'm out of this, I'm out of this. But by the end of the session, ooh, thank you very much. Large operators, two things they require above everything else: liquidity, perceived value. Two things. Then this one here, you get a shakeout demand tail. Now this one here, this is an old technical analysis concept where the ceiling becomes the floor. So the ceiling being the prior base high, the resistance point then acts as support, okay? So the ceiling, you go through that and then it becomes the floor. It holds as support. So you have this base breakout here, pull back down, bounce off the 21, which is also a confluence of holding the prior base high. Nice, confluence, we like it. This is Bowen. Back in 1983. So remember that I was blabbering on about large operators. You'll tend to see them stepping up and supporting stocks around various moving averages, 10-day, 21-day, 50-day. You have to kind of decide on what is the most appropriate moving average or moving averages for the stock that you're looking at. Okay, different stocks move differently. So whatever stock I trade, I pull up the chart and I will look at the previous action of the stock. How does this stock like to move? When it's hitting, when it's a leader, it's got the 52-week highs, how does the stock like to move? Does it like pullbacks and bounces off the 50-day when you see a gap down reverse bar or shakeout demand tail? Bowen, what do you see? Basically perfectly each time, nearly perfectly each time, you see shakeout demand tail off the 50, shakeout demand tail off the 50, shakeout demand tail off the 50. Maybe there's a trade to be had there. Maybe the risk makes sense. That's what we're going to be talking about a little bit later on. But when you see, or when I see shakeout demand tails, gap down reverse bars off a key moving averages, it's telling me the bigger boys and girls are stepping up and supporting the stock where I'd like to see them step up and support the stock. Next one here, McDonald's, 1984, shakeout demand tail underneath the 21. Look at the 52-week highs pre-base, look at the 52-week highs in the base. Look at this here, 52-week highs, and what's it telling you? The market's going down, but the market can't drag McDonald's down. McDonald's going, no. We're holding up here. And then it builds basically a Davis box here. See this kind of rectangle? But this one here, really nice. Shakeout demand tail underneath the 1021. Takes out a lot of the recent lows as well. So think about all the traders trying to get position in here, placing their stop like, oh, knock them out. That's really good. So shakeout demand tails around key moving averages in leading stocks. It's really important. Disney, 1986. Is Disney a leader? All we got to do is look down here. Relative strength line, yeah, 52-week highs. It's a leading stock. So when this stock here goes from, this will be split adjusted 101 times, from $1.50 to $2.50, this is a really important concept that when we do the quiz a little bit later on, pull up charts of these leading stocks throughout the eras. Go and Google what stocks made the biggest percentage move in the 1960s, the 1970s, the 1980s, the 1990s. Pull up those charts. Look at those charts and go, how the hell did the stock go from point A to point B? How did it go up 500%, 1,000%, 3,000%? How did it do it? Have an understanding of the price cycle. Phase 1 accumulation, phase 2 uptrend, phase 3 top, phase 4 downtrend. But look at the chart. Put these moving averages on, look at the chart, go and look at 100 different ones. If you go back and you study from 1960s, 1970s, each decade, and you study the 10 or 20 biggest winning stocks from those decades, the ones that had the largest percentage increases, go and pull up the charts, and when that stock made its move of 500%, thousands of percent, what did it do? How did it move? What were the price patterns? What were those chart patterns? Was it flags, cup and handles, pennants, wedges? Where did they find support? Where did the stock tend to bounce off of? What moving averages are important? When the stock got to those moving averages, what type of candlesticks did you see? I'm telling you the ones that I think I see a lot. Shakeout demand tails, gap down reverse bars, trigger bars. It's those three. Now there's variations of shakeout demand tails, gap down reverse bars, but it's all pretty much of a muchness, right? So it's really important to start, how did the stock get from point A to point B? How did 100 of them do it? How did 1,000 of them do it? What do you commonly see? What do you keep on seeing? Then maybe there's a setup around that, okay? At Disney again, what were we just talking about? Shakeout demand tail off the 50-day. Shakeout demand tail off the 50-day. Do we think Disney is a leader? Look at all the 52-week highs. Look at the volume. Look at the volume. It's a leading stock. So sometimes you don't get that really nice kind of pivot where it just tightens up. No, sometimes stock doesn't do that. It's more kind of V-shaped in nature. It doesn't consolidate like that. So sometimes then looking for, oh, shakeout demand tail here. There's another shakeout demand tail over here. Okay, sometimes the entries are on those. Sometimes the stock doesn't tighten up. Disney over here then does create these more kind of classic pivot areas where you see the contraction. It does it here a little bit, but maybe it's somewhat extended up here. For me, it's kind of like wedgy up a little bit, but there is kind of a little flag in here. But that there, contraction. But sometimes in the base, you don't get the really nice kind of trigger bars. Price just goes tight sideways for 3-5 sessions, something like that. Sometimes it doesn't happen. The stock's going to do whatever the stock's going to do. Cisco Systems, 1995. This one here, shakeout demand tail under what moving average? 21. Shakeout demand tail under what moving average? 21. Shakeout demand tail under what moving average? 21. Is Cisco a leader? 52-week high, 52-week high. You're starting to get it, hopefully. Now, let me just show you on some commodities, okay? So shakeout demand tails on commodities. This is corn in 1996. What do you see? Here's a really nice gap down reversal bar, by the way. Shakeout demand tail, 1021. Really, really nice. The bar before is pretty much a inside bar. Don't have the volume on this chart, but nice inside bar, trigger bar. So gap down, reverse bar, trigger bar, shakeout demand tail. Nice. Silver, micro silver futures. Shakeout demand tail off a what moving average? 1021. See that? Really nice. Look at the base duration as well. This one here, this is corn futures again in 2020. Look at the new, this is quasi like cup and handle type pattern with a Davis box over here. Shakeout demand tail, shakeout demand tail, shakeout demand tail. There's another shakeout demand tail, trigger bar esque in here. So look at the contraction. This is the thing. If you get nothing from this video, like contractions, okay, look for contractions because often, well, always I think they are followed by expansions, and that could be expansion to the upside, expansion to the downside as well. Remember what I was blabbering on about earlier in terms of optimizing profits, black line, blue line, trading stops. I've done a few recent bar by bar deliberate practice videos hopefully illustrating that. Now let's do a couple of gap down reversal bars, okay? So you've seen a couple throughout. This is Nike, August of 1992, okay? So Nike here, you can have gap down reverse bars, but also have little shakeout demand tails. So a gap down reverse bar, okay? The prior close is here. This will be split adjusted 101 times. The prior close is here. It gaps down. It opens here. Shakeout demand tail. Now, why have I put this dash red line? Remember what I was blabbering on about a little bit earlier on. You want to see a shakeout below base lows. You don't have to see it, but it's pretty constructive if you do. So you see how the low of this bar here, look how it shakes out below a lot of these base lows, certainly over the last 3-4 weeks, right? And then it closes on the high of the bar as well. It couldn't close any stronger. It closes right on the high of the day. It couldn't close any stronger. So you have a shakeout that undercuts a lot of the base lows. It's a gap down reversal bar. Location wise, where's it happening? 1021. Okay, nice. Really, really good bar. We'll talk about the risk a little bit later. Cisco Systems, 1993. Okay, so you see here, where's it finding support of action? Shakeout demand tail off the 21-day EMA. Gap down reverse bar with a little shakeout demand tail as well off the 21-day EMA. Is Cisco a leader? Look at the 52-week highs. Okay, leading stocks act in certain ways. Now, this one here, you have 52-week highs coming through, and then you have a gap down reversal bar off of the 50-day moving average, or undercut and then try and reclaim the 50-day moving average. But again, it's a region. So when you see this, okay, Cisco, shakeout demand tail off the 50, kind of pull back down, bounce near the 50, shakeout demand tail off the 21. And then when it comes down to the 50, you're going, I've seen large operators step up and support it. So a lot of the moving averages, they're not magical. They're just reference points for repeatable behavior traits. Where are you expecting certain market operators to step up and do certain things? And then do you see it happen? If you do see it happen, is there then a favorable risk versus reward trade to be had? Maybe there is, maybe there isn't. If there's not, move on to another stock. It's absolutely fine. There's always another bus. So here, gap down reverse bar. The prior close is here, gaps down, okay, comes down to here, opens here, shakeout demand tail, strong close over the volume. Institutions are stepping up. A lot of weak hands knocked out there. Institutions go, thank you very much. Liquidity, perceived value, two things we love. Leading stock, thank you very much. We'll step up. AMD, okay? So I'm going to show you 3 charts now from AMD, and I'm going to make a point here about the stock's previous behavior. I know it made it earlier, okay? What I do when I'm looking at a stock, I will go back and I will study the behavior of the stock. How did it move? When it goes from point A to point B, how does it like getting from point A to point B? Does it like gap down reverse bars off the 21? Does it like tight little trigger bars into the 21? Does it love a shakeout demand tail off the 50-day moving average? Then how does it move after that? What are the best moving averages to use for that stock what are the best moving averages to use for that stock in terms of optimizing the profits? Is it the 10-day? Is it the 21? Is it a combination of both? Is it the 50-day? The stock's action is going to tell you that. I baseline start with 10 and 21, but I'll look back and go, wow, maybe this stock here loves a big trend off the 50. Again, bit of context here in terms of, say, the price cycle. Are you early in a phase 2 uptrend? Are you ridiculously late in a phase 2 uptrend and you've seen four continuation bases already and the stock's up 1,000%? That's also probably going to dictate, in that instance, that I'm probably not going to use the 50 because it's longer in the tooth. I may be more minded to use, say, the 10-day EMA. Why? Because the move seems to be getting a little bit longer. We've seen numerous bases already, okay? So a little bit of common sense, a little bit of context here as well. So we get a really good earnings reaction. Couldn't be any better. Huge volume, 52-week high, gap up, open on the low, goes out on session highs. It couldn't be any more of a bullish candlestick. And then you get this flag type pattern form here. Nice gap down reverse bar off the 10-day EMA. Nice shakeout demand tail off the 10-day EMA. And then you get this nice little trigger bar over here. Look how the volume dries up as well. So for the stock, you're going to have to look back, study the stock's previous behavior. Okay, is a 10-day too quick for this stock, or does the stock like the 10-day? Okay. You need to go back and study that and go, oh, wow, okay, I've looked back, I've found 5 instances after an earnings gap for AMD or NVIDIA or whatever the stock may be, where, okay, really good reaction to the earnings, the 10-day is quick enough. It does like setting up on the 10-day, or maybe you go, I can't find one instance where it sets up on the 10. It likes a 21. It needs a 21 to be there. It needs a bigger base duration. So go back and study the stock's behavior. What does it like? How does it move? How does it like to move? Okay, why? Because it's the same market operators. When that stock starts leading, it's probably the same market operators that are stepping up. They're going to have repeatable traits in terms of their behavior and how they manage their positions. Like you manage your positions and you pick entry, guess what? They do the same thing. They do not do it randomly. Nothing random. Nothing is left to chance. Okay, they have a plan. Like you are trying to create your plan on, okay, guess what? Large operators doing it. They've been doing it a little while, right? Okay, it's not their first rodeo. They know what they're doing. So AMD here, gap down reverse bar of a what moving average? 21-day EMA. Is AMD a leading stock? Look at the 52-week highs. Look at the bouts of volume coming through. Look at the huge volume on the earnings. More volume coming through on the earnings. Another one here, AMD. So this one here, shakeout demand tail, gap down reverse bar off the 21. It's a bit of both, isn't it? Prior close here, gap down reverse bar, opens here, shakeout demand tail to the 21, strong close near session highs. Look at the good reaction to the earnings, and then it starts building. What type of base? Flag, something like that. See the consolidation? Look at the 52-week highs in the base. These are things to be training your eyes to. Great reaction to the earnings, 52-week highs, staying above the moving averages, certain candlesticks around the moving averages, 52-week highs in the base. Again, this is a free tool on TradingView. Search my name, you will find it. Now look at the trend here. It's really, really good to see. AMD again, 2019 looks very similar to this chart here, does it not? Look at the gap down reverse bar perfectly underneath the 21-day EMA. Here you go, 2019. Gap down reverse bar perfectly underneath the 21-day EMA. So gaps down here, remember, when this opens, it looks horrendous. A lot of traders will use, say, the 21 as their trailing stop. Oh, it's below. I'm out. By the end of the session, oh, gap down reverse bar. Shake them out. Really nice. Gap down reverse bar. So the prior close here, gaps down, opens here, pushes up, strong reversal. What do you notice about the volume as well? And not much volume. It's not even above the 30-bar average. What does that tell you about supply? It's not that much supply. It's not that much selling. And then you're going to get this really nice inside trigger bar. Low volume. See how it dries up? Look at the 52-week highs. Look at the volume coming through. Type of setups. Gap down reverse bars, commodities. Corn futures, we had a few corn futures, haven't we? 1979. Gap down reverse bar off of the 21-day EMA. Over here, gap down reverse bar off of the 21-day EMA. Corn futures again, it looks very similar. How similar does that look to the AMD chart? Look at the gap down reverse bar underneath the 21. Look at the gap down reverse bar underneath the 21. Gold futures, gap down reverse bar off the 21. Was gold showing relative strength versus the S&P 500? What we've got to do is look down here, 52-week highs. It's really nice. First pull back into the 21, gap down reverse bar. Nice, we like it. Now I'm just going to show you this before we go into the quiz, that you will have different time frames, same patterns. It is literally supply and demand. It is absolutely timeless. So really dial it in terms of contraction and expansion. Okay, expansion follows contraction. contraction, contraction, contraction when you are looking for trigger bars. It's really key. So look here, okay, 1 hour chart. What chart pattern do you see? A flag. Look at the volume coming in. Okay, in here, look at this. I call this bullish synchronicity. Widespread candlestick with volume confirming the move. It's really good to see. Then look at the tightness. Look how the volume dries up. This stock goes from $40 to $140 in a hurry in 3-4 hours. Really quick. GFAI, okay, look at the volume coming in. Can you see how important the volume is pre-base, in the base? Look at the volume, bullish synchronicity here, pulls back in, finds support with this tight little trigger bar on the 50 period moving average for the 1 hour chart. So I will still use, when I'm on intraday charts, I will use the 10, 21 and 50 period moving averages for that time frame. 10 EMA, 21 EMA and the 50 simple period moving average for those time frames. Look at the demand, look at the bullish synchronicity, and then look at the tightness, look how the volume dries up. Expansion follows contraction, really important principle. This one here, this is Berkshire Hathaway monthly chart. Monthly chart. We were just looking at the 1 hour chart, now we're looking at the monthly chart. What chart pattern do you see? Bit of cup and handle, bit of kind of VCP action, starts building higher lows, right? And then do you see shakeout demand tail? Shakeout demand tail, shakeout demand tail off the monthly 10 EMA. When I'm on the monthly charts, I'll use the monthly 10 EMA. Look at the 52-week highs in the base. So see this month here, it hits a 52-week high in the base after showing relative weakness with the 52-week lows being the red dots. It starts showing relative strength. And then here you go. Out of this contraction comes expansion. Out of this contraction comes expansion. Expansion follows contraction. Now we'll just drop it down onto the 5-minute chart. What chart pattern do you see here? Flag, wedge, pennant, whatever you want to call it. Look at the volume coming through pre-base. Look at the strength of the trend pre-base. Okay, now it pulls back in, tightness in price, low volume tells you there's hardly any supply coming in. Then here you get another kind of flag, wedgie, pennant type pattern, whatever you want to call it. Inside bar, low volume, out it goes, sitting on the 10 EMA moving average for that period. Same over here as well. So it's not just what's happening, it's where it's happening. Now this here, this is a penny biotech stock pre-market. Same patterns. It's timeless. It doesn't matter whether it's the daily chart, the 1-minute chart, a penny biotech stock pre-market. It doesn't matter. It's the same principle. Look at the move here. Okay. Look at the bidding. Lewis Hamilton's F1 car. I'm bidding. I'm bidding. I'm bidding. I like it. I like it. I like it. I want it. I want it. Okay. Look at the move here. See how it's not chopping around all over the place. Really nice move. It starts pulling in. Look at where it's finding support. What moving averages are you noticing? Okay. What moving averages are you noticing? This is for the 1-minute chart, but it's the same using the 10 EMA, the 21 EMA, and the 50 SMA for this time period. Okay. Look at the tightness, tight low volume inside bar, tight low volume inside bar, sitting on the 10, sitting on the 10. After here, a bounce off the 21, sorry. This here, PLTR, cup and handle type pattern on the 3-minute chart. So a little kind of gap up here. Here's the cup, here's the handle. Look at the shakeout demand tail that marks the low of the cup. Shakeout demand tails marking the low of a cup in a cup and handle type pattern or a gap down reverse bar is really good. So shakeout demand tail, recovery, and then look, tight, 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 low volume inside bar following this shakeout demand tail. What follows contraction? Expansion. Don't matter if it's a 3-minute chart or the daily chart. VCIG, flag type pattern here. Look how the volume just stair steps down. Look at the tightness onto the 10. What follows contraction? Expansion. WLDS, cup and handle type pattern here, shakeout demand tail for what moving average, and then you get contraction, nearly an inside bar sitting on the 10 period moving average. What follows contraction? Expansion. Then here, now we are at the quiz. So let's see if you learned anything. We've got 6 questions. Let me know in the comment section if you want to how many you got right. Now I don't know how you're going to let me know quite how many you got right, because there's going to be lots of different answers to them. But let me know how you did. Did you find them all basically? So we've got 2 bases here, okay? We've got base 1, we got base 2. Can you find the 2 textbook 21-day EMA trigger bars? TBs are trigger bars. And base 2, can you find the 2 textbook 50-day simple period moving average trigger bars? This one here, nice and easy one to begin with, okay? So I'm going to change it in 3, 2, 1 and show you the answer. There you go. Here they are, right here, okay? So base 1, where are the textbook 21-day EMA trigger bars? Right there, right there. 50-day, right there, right there. And there's a little gap down reversal bar before them as well. Nice little kind of shakeout demand tail there as well. Let's go on to question number 2. Nice and easy one, okay? Following the earnings gap, so this is the earnings gap. Hopefully you were dialed into that. Did you see the 52-week high? Did you see the volume coming through? Lots of things to notice. Can you find the 5 shakeout demand tails off the 21-day EMA? There's 5 shakeout demand tails off the 21-day EMA. You ready? 3, 2, 1. There they are. Shakeout demand tail off the 21, shakeout demand tail off the 21, and you can undercut the 21, okay? Shakeout demand tail off the 21, shakeout demand tail off the 21, shakeout demand tail off the 21. That's also an inside bar, low volume. Now my two favorites are actually the green real body ones, would be this one here and this one here. I would prefer the candlestick to be green instead of red. Why? Because green would indicate it is stronger. It's a better indication of strength coming through. And then obviously you need to make sure the wrist makes sense, and we'll do that a little bit later. Hopefully you kind of dialed in, starting to recognize, okay, some candlesticks, some lines, some earnings gaps. Okay, 52-week high, good volume. What did the candlestick do? Gap up, wide spread, open on the low, close strong. Okay, interesting. Let's do quiz number 3, Lululemon. So from June through August, can you find one gap down reversal bar off the 21-day EMA, 2 textbook shakeout demand tails off the 21-day EMA, and 1 trigger bar off the 10-day EMA? So pause the video. 3, 2, 1. Here we go. There you go. So this is the one gap down reversal bar off the 21-day EMA. So yeah, gaps down, opens on the low, closes really strong. It's a really good sign. Would have been a little bit wide for an entry there. And then if you're looking for the 2 shakeout demand tails, the 2 textbook ones, remember what I said, I prefer green real bodies instead of red real bodies, okay? This would be one in here. Shakeout demand tail, strong close. Here, shakeout demand tail, okay close. And then this is the one trigger bar off the 10-day EMA. Are there a couple of other shakeout demand tails? Yeah, there's this one here, there's this one here as well. There's this one here as well. There are some other ones for me. Those are probably the 2 most textbook ones that I'd be thinking of. Let's do Tesla. So quiz number 4. From April through to June, can you find the 5 shakeout demand tails and gap down reverse bars off the 21? So there's 5 candlesticks to find, okay, through April, so here to June. So you're looking from here to here, here to here. Okay, there's 5 shakeout demand tails and gap down reverse bars. 3, 2, 1. There you go, off the 21. You have gap down reversal bar, shakeout demand tail, gap down reversal bar, gap down reversal bar. Look at the strength of the closes on 4 of them. Kind of, this one's okay, but it's not great. I prefer green real bodies. But look at the strength of the close here, 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 here. Those 4 that I was just pointing to going out pretty much on session highs. Much better indication of strength. Really, really, really good. M-phase NG. So you've got 3 bases here. Can you find 1 shakeout demand tail, 1 gap down reverse bar, and 1 trigger bar, all at the 50-day moving average? Can you find, so base 2, can you find 1 shakeout demand tail and 3 gap down reversal bars, all at the 21-day EMA in here? Base 3, can you find 1 gap down reversal bar off the 21-day EMA? 3, 2, 1, here you go. So there they are. Okay, here, let's start with base 1. Can you find 1 shakeout demand tail? There it is right there. Can you find 1 gap down reverse bar? There it is right there. Opens on the low, close on the high. And then there is your tight low volume inside bar. Sorry, it's not quite a inside bar. But see how it's just tight bar, low volume, sitting on the 10, 21 and the 50. Base 2, 1 shakeout demand tail. There it is right there. And then 3 gap down reverse bars. There's one, there's one, there's one, and I actually missed one. There's 4. There you go, there's 4. Even I missed one. Can you find 1 gap down reverse bar at the 21-day EMA for base 3? There it is right there. See how it gaps down, opens on the low, reverses, belt hold bullish, reversal rate 71%. It's really, really good type of candlestick. So can you see in terms of leading stocks how many entry opportunities there are when you start seeing trigger bars, shakeout demand tails, gap down reverse bars, knowledge of key moving averages, how do leading stocks move? How do you know M-phase energy is a leader? Hopefully your eyes just went straight down to the bottom and chart, 52-week highs all over the place. Really good to see. Now NIO here, this is the final one. So when I was talking earlier about pull up a load of stocks from different decades that made the biggest percentage moves, how did they move? How did NIO go from $2 to $50? How did it get there? How did 100 other stocks get there? What did they do? How did they act? If they came down to, say, the 21, what did you see? Is that a moving average you can look at and see, oh, okay, there's supportive action around there more times than not? It's not just fluke, it's not just coincidence. I'm seeing that a lot. I'm seeing candlesticks that I would associate with accumulation, with absorption of supply, with large operators trying to shake out weak hands. Okay, it's really key. Study, how do they get there? What are the type of bases that you see? Maybe you find out that the 27 EMA is the best. I don't think you will. I think it will probably be somewhere around the 10-day, the 21-day, and the 50-day. That's why I use them on my charts, what I found out. Okay, but maybe you find, wow, the 25-day, the 29-day EMA, maybe you find that out. But you'll only find that out from doing your own research, from studying it yourself, from seeing it yourself. You need to see this yourself. Okay, you need to study stocks very, very deliberately. How do they go from $2 to $50? How did 100 of them do it? How did 1,000 of them do it? What are you seeing? Can you create setups around that? Can you create entries around that? What are you then going to do from an identification standpoint? What are you going to do from a controlling risk standpoint? What are you going to do from a risk mitigation standpoint? How, when a stock goes from $2 to $50, how do you optimize the profits? What are you doing to try and capture large trends? What are you then trying to do when the trend starts to turn? How are you getting out? What are you doing? What are you selling rules? What are you selling guidelines? Okay, it can't be haphazard. If you're doing random things, you're going to get very random outcomes. Okay, really focus, be very, very specific in terms of what you are doing. So from the first big breakout to the first close below the 50 period moving average, can you find all the possible entries using trigger bars, shakeout demand tails, gap down reverse bars around the 10-day EMA, 21-day EMA, and the 50-day simple period moving average? I'll give you a clue. There's a lot of them. Ready? 3, 2, 1. There you go. Whole heap of them. How many opportunities do you want to get on board a leading stock? Is that enough opportunities? So when you start seeing stocks in this manner, you go, okay, check out demand tails, gap down, reverse bars, leading stocks. How do you know it's a leading stock? Look at all the volume, look at the 52-week highs. Look at the trend. Look at how the stock is moving as well. So another thing on a leading stock, it should move in a certain way. It should find supportive action around certain moving averages. Now, oftentimes the 10-day is going to be too quick. Here you can see, okay, NEO did find supportive action around the 10-day EMA. Oftentimes the best moving average, if I can only have one on my chart, it'd be the blue line, 21-day EMA. That's the one I give the most weight. That's the real sweet spot. Okay, 50 period moving average can oftentimes be too slow. Why? Because you can see here, it only pulled down to the 51s. Next time it did it, well, it just cracked through it. Bearish synchronicity, volume accelerating as well. Not good. But the 21-day, numerous times you can see the stock setting up around the 21. 21's a real sweet spot. Okay, so 10-day, 21, and 50-day, all important. You'd like to see them all trending up quite nicely, but the 21 for most stocks, most leading stocks, 21-day for me would be the real sweet spot. 10-day can often be too quick, 50-day can often be too slow, so it's kind of like Goldilocks. Okay, 21. Just right. So what we are going to do now is I'm going to take you across to my custom built screener, and I'm going to show you how on earth do you screen for these type of setups in minutes. Okay, we're on my custom built stock screener called Stock Screen Hero. Now this is specifically designed to identify those type of setups you were just seeing in that presentation in minutes. I'm not joking, in minutes, okay? So there are preset screens where you can go and create your own screen as well if you are a member. So what I'm going to do is go US continuation base screen. Now what I like to do is cast a relatively wide net. I don't like to be really onerous, but I like to filter that net via relative strength. And relative strength on a 3-month basis is the real sweet spot I found. It's for those flags, wedges, Darvis boxes, pennants. Okay, 3-month relative strength will get those type of stocks. I was just showing you those setups to the top of the proverbial net. Okay, so I like to cast a relatively wide net as we're doing here with the continuation base screen. Market cap above 100 million, last closing price above $1, price above the 50-day, price above the 200-day. Why? Because in all of those examples, did you see a single setup that was below the 200 or below the 50? No, you didn't. So that's why I'm adding it in here in the criteria. 50-day average volume, 50k, relative strength rank on a 3-month basis, greater than 75. Can you add a load of other stuff? Yeah, absolutely can. But what I like to do, cast a relatively wide net and then filter that net via relative strength. So what I've done is I've selected to have the 99 RS, 3-month RS to the top. So that is the strongest stocks on a 3-month relative strength basis at the top of the list. So then we're going to hit charts. If you hit flex charts, you'll get the earnings and the sales data as well. So here we go. We're going to hit charts. You're going to see 1 per row, but you can, if you want to change the settings, have 2 per row, so it's super duper quick to be scanning, okay? And then the moving average you see is going to be the 21 period moving average. And look at this already. This is the very top stock. What was I just talking about? Shakeout demand tail, tightness and price, contraction. And what follows it? What follows contraction? Expansion, okay? Really, really key. Now I'm going to specifically just scroll down to one stock, which is Affirm, because this is one that I was targeting the other day. So I will take you through the thought process. Let me just scroll down here and find it. It's going to be on the first page of results. Here it is. Okay, so I was targeting it on this bar coming through here. So I'm going to jump into TradingView, but this is how I find them. I focus on stocks that are in uptrends, displaying the highest relative strength. Again, relative strength. It's not my opinion. It's not your opinion. It's the opinion of the market. The market won't miss the best opportunities. So what we're going to do is jump over to TradingView, and on this little shakeout demand tail here, okay, we're going to be setting up the trade. So this is how I was setting up the trade. Now I absolutely balls this one up because it had a little gap and I cancelled the order. I shouldn't have done that. But let me take you through a couple of key points. Okay, so if from a price cycle standpoint, okay, phase 4 into a big phase 1 looks like it's trying to transition up and out of a phase 1 base. You get huge volume coming through on the earnings here. Bullish synchronicity, opens on the low, closes strong here. You get good volume coming through here, which ties in with a 52-week high, but the stock's running into overhead resistance at the top of the base. Needs a little bit of time. When you then start looking at the chart pattern, what chart pattern do you see? I see a cup, and then I see a handle forming here, and the flandel, that was a combination between handle and flag. That's how my brain moves. Okay, so look at this here, flag type pattern. So then you get this inside bar sitting on the 10-day and look how the volume is just step down. Okay, look at the spouts of volume coming through in here. Look at the pop there. Look at the shakeout demand tail here. So it's pulling back in. Now this stock here has a very high average daily range percentage over a 20-day period. So the ADR, the 20-day ADR percentage is nearly 7.5% on this bar here. That's really, really good. As I said, we're going to add ADR percentages into the screening criteria on Stock Screen Hero, and then it's just going to be ridiculously good. Okay, really, really, really excited about that. But anyway, let's set this one up. So I balls this one up because I cancelled the order because of a little gap. And when it gapped up the next day, I should just waited patiently and let it fill on a retest, but I didn't. Okay, I make mistakes. But anyway, here's how I was setting up the trade. If you're a member of my platform, you can go and watch the weekday video for Wednesday the 22nd of November, and you can go and see me doing it. Okay, without the knowledge of what's going to happen next, of course. So here we go. So how I'm setting the trade up is like this. I will use the fib retracement tool. So this is the fib retracement tool. Go over here, grab it like this, put a star on it, put it into a favorite bar for you. So I'm snapping it to the high and the low. Hold control to do that. If you want to know the settings, I'll double click on it for you. Go style. So 0 is going to be your stop loss level. 1 is going to be your entry. 2 is going to be 1 times your stop loss, wherever that may be. You can move it up, and 3 is going to be 2 times your stop loss. That could be where it is, but obviously I could move it up like this, and then that's going to adjust those levels. So the magical level is selling half of the position at 1 times the stop loss. That could be new, that could be an initial or new stop loss, or 2 times selling 1/3 at 2 times the new or initial stop loss to free roll. But what I like to do is look at the ADR, the 20-day ADR percentage. How do I get that ADR? I use this one here by Armour Schluckler. That's the one that I use there. Okay, so what I like to do is try and get the initial stop loss half to 2/3 versus the 20-day ADR percentage. It's a nice metric. Now sometimes on these more volatile stocks it'll be a little bit harder to do that, but initial stops half to 2/3 the 20-day ADR percentage is pretty good. It's a nice metric, just like a checkpoint. And then obviously we're looking for certain candlesticks around certain moving averages. Okay, so let me just play this one forward. Okay, so there's the entry, and you can see it was a little kind of gap up the next day. I don't really like gaps. It gapped above I use a buy stop limit order. I was looking to buy it within 0.5% of the high of this, but I kind of gapped above, and I was like, I don't really like gaps. I'll cancel it. I shouldn't have done that. Okay, but imagine this here is the entry. And let's say we're going to go, right, we are going to try and free roll by selling half of the position at 1 times the stop loss. So our free roll level, let's assume really good execution, is 26.38, because we're just like, okay, we just want to get this free rolled and try and do it underneath base highs. Okay, so here we're able to free roll the trade. So we take a half off right here. So we sell half of the position right here at 26.38. That's absolutely fine. And now if we start playing it forward, okay, now it starts getting out. So what follows this period of contraction? Expansion to the upside. Now, as it starts moving up here, you might go, this on a short-term basis is really extended. So for me, there's a couple of things to do here. Number one, go back and study the behavior of the stock. This is a stock that can get kind of ahead of itself, extended, and then reverse quite hard. So my kind of then management, what do I know? I cancelled the order here, okay? But for me, what I'd be thinking with this stock is, okay, when it starts getting extended, I want to be choking some off, lower the day, lower the day, lower the day, and then using the 10-day for the rest. So up here, as it starts getting extended, what I would be thinking here, again, what do I know? I cancelled the order, right? But what I'd be doing is just adjusting my stop loss on part of the position. Okay, imagine I'm like trailing a stop loss up here, but just adjusting the stop loss up a little bit. So then I'd be knocked out here for a quarter of the position. So 1/4 is gone there. Now that's not bad, pretty good in terms of time value, 44% in week and a half, something like that. And then I'd be keeping some back, so that's going to be a quarter of the position right there, and then keeping some back for the 10-day EMA. Okay, and then that would be present day. So then just still trying to ride the 10-day EMA. But that there is how you can go and screen for those type of setups in a very quick manner. Okay, focus on stocks that are in uptrends, above 50s, above 200s, and then filter that net via relative strength. 3-month relative strength is the real sweet spot. So I really hope you guys have enjoyed that video. You've learned a lot about identify, control, mitigate, optimize, also about how to efficiently screen for those positions, how to set up order entries as well, how I go about doing it using a buy stop limit order and attaching the stop loss as well. And I hope you have enjoyed that video. Thank you very much for the support on the channel. It is very much appreciated, and I look forward to seeing you in a future video.